Hello, folks. Brandon Chapman with you today for another Monday video from Theo Trade. It is March 25th, 2024, and volatility markets flashed the first warning sign since December as NVIDIA tests new highs. So again, interesting dynamics playing out right now as we're testing the strength and the fervor of this bullish move in the S&P as since really it's faded a bit since around the March 8th. But of course, the Fed reignited that last week with its breakout in the S&P 500. So we'll kind of talk about this. We'll look at some other stocks exhibiting unusual option activity like Micron, Western Digital, ARM, Target, AGNC, AT&T, and Bank of America, to name a few. As we look at the S&P during the cash session today, I've got some unusual prints here, 1.68 million, 1.16 million that we broke through last week. We're peeling back over the last couple of days. The S&P finished at the low of the session today, down about 0.25%. You'll notice the top performing sector today was energy. We're going to look at SU today as some bullish option activity there. If you see SU kind of breaking out today. But energy is an aerospace I've generally been bullish on. We'll talk about that. Utilities and materials were the only positive sectors today, whilst technology generally was lagging, was down on the session. Of course, we have stocks like Apple, for example, tied up in its antitrust case. We've got Google in the mix as well, down slightly today. Microsoft. So we understand why technology is down generally. Meta, in terms of communications, was down 1.29%. Google's tied in that as well. But we understand why technology is down because a lot of these big cap names are down. But really, it's NVIDIA is the stock that really matters in this technology space. And it has its own ecosystem, right? MU, huge move today, up 6%. Bullish option activity in Micron. Western Digital, another semiconductor stock, up 1.5% today. ARM Holdings, a stock that may be breaking out of a symmetrical triangle, although it did fade late in the session with the broader market. And so as we consider all these kind of bullish and bearish stocks that are going pulling up and down, as we consider the broader market, the S&P 500, we'll use the SPY here. What is the expected direction? And we've really been on hold since about March 1st. If you look at the S&P in gold terms, we strip out the dollar's weakness and we bring up what's called a pairs ratio study. It's just a relative strength study between the S&P and gold. Notice that today, gold not only outperformed the S&P 500, but the S&P's 500 is back to the same level it was, for example, on January 22nd. If we go back to mid-December, back here on December 14th, we're not too far off of that December 12th level, which goes back to the level last seen in August. The S&P, when we consider, once we strip away the dollar's weakness and we look at it in gold terms, we're really not that far off of, for example, August 1st. So if we strip away and we add back the dollar, and we say, okay, well, how is the dollar's weakness attributed to the strength in the broader market? Let's go back to August 1st. Look at how much we are higher today than we were back on August 1st. And we just realized that almost all of the gain in the market, all of this is all based on the dollar going down. And as you begin to look at gold, which is kind of the best way to kind of reflect the dollar's strength or weakness, gold's had a huge breakout, in particular the last few weeks, and we're consolidating at the moment. We may be setting up for another breakout again. Or the dollar starts to strengthen and we break down. If gold breaks down, this is indicative of a strengthening dollar, and that should also be deleterious on the market as we start to take away all of this lift that we've experienced in the S&P as a result of the dollar falling in value in real terms, not just relative terms. For example, you can look at the euro/US dollar, and you might have a different take on the dollar strength or weakness. Since August of last year, the dollar's probably down a little bit, strengthened a little bit against the euro. But again, we got to consider it in real terms, right? Because the euro's losing value, the dollar's losing value. It's helping to lift those markets. Even the dollar/yen, the Bank of Japan threatening maybe they have to intervene if the yen weakens even further from here. They raised rates and obviously weren't as hawkish enough, and the yen sold off. And so we're seeing this array of global currencies really weakening in dollar terms. And again, weakening in gold terms specifically, right? Gold is strengthening against all of these major currencies globally, and it's helping to lift stocks, but the purchasing power of stocks are declining. If we look at this in gold terms, SPY plus GLD, we can consider this the purchasing power of the market. And we'll see it really has not gone up much at all since really going back to even early July of last year. If we look at this ratio over here. So again, it just reflects how much of the market's strength is centered on and is reliant on dollar weakness. And if that dollar begins to turn, we may see the market decline. Now, how is that being represented in the volatility markets? Well, normally VIX, as the market reaches it towards its peak, the VIX reaches very low levels. Last Thursday, for example, it reached similar levels that we saw, for example, in December and January, down a little bit over 12. We were up slightly on Friday, and we gapped up open this morning and then kind of faded back throughout the trading day. So volatility went up a little bit, but then faded, only finishing up marginally on the session. But we're still down here in the lower end of the range over the last year in the VIX. So as the VIX goes down, that's the low-hanging fruit, right, in terms of market performance. Go back to, for example, late October back here when the VIX was at 22, and it dropped to 12. As we went from 18 in February and we dropped down here to 12 again. It's the path down in the VIX that ultimately is the most surest path to higher market prices. Look at this rally here in the S&P as the VIX was getting sold and we were getting bid in the market. And then in February here again, we saw another leg here in the market as the VIX went lower back to 12 again. But the best way to consider the VIX in terms of or in volatility based on expected movement is looking at a ratio of the 3-month VIX to the 1-month VIX. This is kind of a proxy for what you might regard in the VIX futures, for example, /VX in here. You can look at the futures prices for the VIX. You could take a 30-day weighted average here and compare it against the spot VIX. Just taking a straight average would be about 15. And so we compare that against the VIX, which is around 13, right? Well, guess what? The 3-month VIX, if I go back to VIX3M, the VIX3M is about 15.5. So if we take just a straight average of the VIX futures, the two contracts would make up that 30-day weighted average. It would be about 15, but we're seeing here the 3-month VIX is about 15.4. And so if I take a ratio, see how much greater is the 3-month VIX against the 1-month VIX? Well, right now it's about 1.16. Now you can see the highest side might have been about 1.18. When you look at this intraday, we saw some rather bigger spikes in this ratio on Thursday and again on Friday. Both times it finished lower in the session, but it reached a level here of about 1.195. Okay. 1.2 is a threshold which says that the 3-month VIX is 20% higher than the VIX. This is a level that we look at as being rather significant in terms of expected volatility. The last time we kind of crossed above was in later November in here, above 1.2. And I go back to December 14th as a day where I personally really started to change my outlook on the market and saying, look, this is a time to take profits and hedge. December 14th was right there. So this actually kind of dipped below that day below it, but it was a day where the skew was elevated as well. If we go back to skew here, skew on the December 14th was ramped back up again. We're right around right there. For example, on the 14th, we ticked up to 152 and sharply rose over several days from about 130 on the skew index on December 7th up to 152 on the skew index. So on that day, as the S&P was stretching at the time on December 14th above the expected move for the week, it was a very good point to say, look, now's the time to consider taking profits as the expectations for future volatility are really peaking right now. And this was a good time. And I walked through what we call an atomic hedge back here on the 14th, saying, look, take 30% of your profits off the table, right? Reduce your exposure from, let's say, 100% to 70%. And then we walk through the idea of hedging, right? Buying a hedge that would reduce your portfolio, your positive beta weighted delta from 100 down to about 46, 47%. in essence, reducing your exposure to the market for basically by half. And that would have been over the next 6 weeks. Well, over the next 6 weeks, it would have been pretty reasonable, right? You had a little drag, but eventually what happens is the call verticals expire. We uncap the upside. Yes, the puts expire down here that you buy, but the puts were paid for. And we had a point where the market was likely, or was very probably, going to see a large decline, 5 to 10% plus. It was in correction territory based on these volatility-based indicators. Well, guess what? We just reached the same point here last week. We were well above the expected move post-Fed. We started to kind of drift there on Friday just a little bit, but both on Thursday and Friday, these volatility-based indicators, not quite as peaked, but intraday at least, reached a level that I would see rather significant. And boy, when you look at the skew today, going up on Thursday and Friday, jumping to 150 Friday's 155 at Friday's close, it puts into perspective how much crash risk is at this level up here. Again, normally when you see these kind of triggers, you're looking at a 5 to 10% pullback in the S&P, and a 10% pullback would get you back to 470. I mean, that would only seem reasonable after this 30% move that we've seen in the S&P off of its October lows. So the point is, you don't have to take bearish bets. You can take some, but the fact of the matter is the volatility-based indicators, the degree of hedging that's going on right now as represented by skew, and the selling in the front month vol creating that steep term structure, expecting volatility out in the future, is now as peaked as it's been since December. Now, again, while we didn't experience that correction in December, how many times can you have these incidents of extreme volatility readings based on hedging activity tell you that we don't get it, we don't have anything? And we look at NVIDIA while it's retesting its prior highs. I've been kind of saying to, during my session that when you get these kind of parabolic moves, the bubble kind of breaks here, but you normally will retest either the open or the body or the high. Today, we came very close to testing the high in NVIDIA, and we'll just have to see what happens. Okay. Is it possible that NVIDIA breaks through these highs en route to a new higher high and even further gains? Yes. Is it likely? Well, maybe it's 50-50. Maybe it's 55-45. Point being is that it would be reasonable at this point in time to consider the skewed nature of the downside to take profits in some stocks, reduce your exposure, and potentially hedge. Doesn't mean you have to close out NVIDIA, but boy, at some point, this is going to have a wicked move. And this was an example of a 10% move intraday. We could see even a bigger move in NVIDIA, and we might be getting close right now. So you could try to gamble and bet what the market's going to do, or you say, look, this has been a big move. Institutions are buying hedges as represented by skew. We're seeing front month vol being sold. We're seeing back month volatility being relatively high compared to that front month. There is expectations of volatility. Now's the time to take some profits and hedge. Take some of the edge off. Maybe you go from 100% being allocated down to taking 30% profits down to 70%, and then executing some sort of hedge like we teach, like an atomic hedge might take you down to 50%. And you still have the opportunity. If the market keeps going up, you can still make money because you got 50%, right? If your delta is reduced at this point in the market's so extreme at the moment. Just a consideration to make while things are testing very, very extreme levels. Now, we can say NVIDIA, but you look at Micron today. I mean, no real news, right? Certainly there was news of trying to, China retaliating and obviously affecting companies like AMD and the like. You have news as the antitrust stuff with Apple, for example, Google. I mean, who knows what the effect will be on companies like this, but there's still potentially opportunity in this technology space, again, because NVIDIA is not for certain to go down here, right? So you can speculate, and right now you're being rewarded to speculate a little bit to the upside. And let's take a look at ARM just as an example here. So ARM potentially breaking out of a symmetrical triangle. My comments earlier today was if we finish at the high of the session, you might consider buying an out of the money call spread. Well, if we look at ARM and you look at the volatility here, what you'll see if I scroll down, you can see that the volatility is increasing as you move out of the money. Today it was a 28 March 150 all the way out here, 14,000 contracts, mostly bought at the 145, mostly bought at 140. I mean, a lot of buying in ARM, a lot of between the market as well, but wanting to speculate. That's why the volatility is increasing as you're getting out here, right? Well, you could go out potentially 11 days and just go out of the money a little bit. What's a 139, 141? Well, it might cost you 80 cents. You're buying 62.3, selling 63.4. There's a little bit of volatility edge in that, right? Certainly that would be representative of the options being traded or bought mostly on these out of the money strikes. You don't need a huge move to 141, but if we see a continuation here, again, today's high, a little bit above it, maybe you might have a chance of closing that out for probably maybe around 70-80%, and that's for this 11 days expiration 5 April. Just buying the 139, selling the 141. Okay, so again, you risk 80 cents to make what, $1.20? Cut it off about $1.30, $1.40. Great, you're in a good position. ARM, Micron today, again, another stock, technology oriented, right? Semiconductor oriented, broke out, huge move today, was up 9%, finished only up 6%. Would have liked to have had it finish near the high of the session for a continuation. But today's trade in Micron, again, out of the money options for this 28th March expiration. So this is kind of a make or break week for semiconductors. You can kind of see here 120, 125, 130, even in the money here at 115. I'll call out the 116 here, buying 10,000, mostly 10,000 contracts against 1,600 open interest, but a tremendous amount of buy-side activity, very short dated in Micron. So again, but it does create a vol structure that's rather positive, right? You can buy the lower vol and sell the higher vol. Buy a 118, sell a 120, 32 days out. You got 32 days for it to go to 120. We break through the high here, 123, 124. You probably have a chance to close out that spread. Buying the 118, selling the 120, probably costing about 80 cents. You may close it out for $1.30, $1.40. Look to make about 70% on that. Again, another opportunity in Micron. What about Western Digital? Not up as much today. Oops, tries again. WDC. Not up as much, but a nice bounce, 1.63%. We held on to the low of the gap day. The high up there is about 66. Do we break out and go higher? Certainly reasonable. Today's trade in WDC on the option space was actually for an April expiration, and it was out of the money at the 67 strikeout here, right? Possibly the 68 as well. But the idea being is they're buying these out of the money strikes, 67, 68, that's here. Okay. We're currently trading at 65. What if, for example, a 19 April expiration, do we have volatility skew that's favorable? We're at 65, 67 points, 37.65, 38, 38.3, right? We have positive rising volatility, positive vol skew. Buy a 65, sell a 67. Okay, maybe cost you 85 cents or so on that one. 83 cents. So I guess we can go buy deep and wide, 112 strike vertical. But again, you get an idea, right? 83 cents to buy that spread. Upside max gain is $1.17. If you could sell that for $1.40, $1.50, you have a chance to reel in maybe a 70, 80% gain on that. Again, what would that take? We're 25 days out. Might take us pushing to 68 plus to get that in a very short move. But again, we're in a very good position bouncing today, engulfing. Now you might say, well, you're talking about bullish trades and you're talking about a potential sell-off. Yes, right? There's a likelihood the market continues higher for a few more weeks. We're experiencing stocks in this technology space that have positive skew. We'll address a few bearish trades here, but another bullish trade is SU. Energy, well, Suncor Energy breaking out today. Volume was a little bit below average, but closing near the high of the session. You could see what happens tomorrow, but again, the vol skew, is it unfavorable? Not really, right? I mean, you could buy a 37, sell a 38, a $1 wide spread. It costs you maybe 38 cents. Upside is 62. You could go maybe 37 and a half, 39, again, buying similar levels of volatility. So you don't have, or selling at 39 and a half. Again, the idea, you're just looking at the upside of this stock in here, looking for a continuation of the energy trade. If we kind of zero on a 40 delta here, 37.5, 21.96. Again, buy the 37.5, sell the 39. It's 37.5 is only about 80 cents out of the money. Volatility is about 25%. You'd be basically buying and selling similar levels of volatility here. No real edge, but boy, we'll break even quick if this starts to get in the money at 37.5, which is right up here. And you've got what? You've got 25 days for that to happen. And part of the reason why the energy trade is still bullish is the fact that, look, there's an implied shortage bounce in oil today. But boy, you start to look at the product depth forward/CL, and what you see is that oil is still in backwardation. These falling prices are bullish for oil. These back month prices are going to catch up to the spot. So we're going to see upward pressure on this complex. And again, 85, 90, where's this going to go? $95? But the reality is the producers out there, of which Suncor is one of them. So go to the Analyze tab here. We see Suncor, integrated energy company in Canada, right? So again, integrated. So again, you pull it out of the ground to distribution, similar to Exxon and similar to Chevron as well. Those stocks were up nicely today. MRO is another more integrated name. It was up 1.73% today. So again, Suncor is just another stock in that portfolio of stocks that are integrated in nature that are exhibiting bullish option activity. And today's trade in Suncor was for a May expiration. So we got here a little bit and flip this to this. See that again. It's moved in the money at 35 today, but again, 35 strikes example of money flow, right? Coming to the space, looking for upside in Suncor. So we talked away some ways to play that using spreads. Let's flip it to the bear. Well, let's look at Target. One more. Target, consumer defensive stock. I mean, came off a pretty big earnings. Nice bounce today, kind of bouncing off a 2-day pullback. Near-term resistance around 175. But again, if we look at this as kind of a pause that refreshes, could we get a move to 176? That gets you back to prior high, slightly above. Definitely reasonable, but the trend could carry to like 185 here. And if we go back, let's go back 10 years, you'll see 185 is where it's about a 50% retracement of the downtrend in 21 through 23. So reasonable as a near-term target here. Can you get favorable terms? Well, the trade today in Target, this was again for this week, 28 March out here at the 177.50. Can we get favorable terms if we go out to, let's say, 53 days to expiration and target maybe something a bit higher, like 185, for example? Well, we come back here, 185, the vol's at about 21.72. The 180 strike is going for about 21.79. So you could construct something up here like a 180, 185. The delta on that is at about a 34. So not a super high probably trade, but the if we buy vertical here, the cost is about $1.28. So it's for $5 spread, not terrible. We are creating a relatively wide spread, looking at 185 and 30-something days. Reasonable that could happen, right? If you want to go with something a little shorter, closer to the stock price, you might be able to squeeze something in for 11 days out, closer to the current price. See the volatility is rising here, like a 175, 177.50. Buy vertical, it costs you maybe about 68 cents, risking 68 to make what? About $1.82. Not terrible, right? So the point is that there are low risk, high reward trades if Target goes up. If we flame out and the market comes crashing down, as long as you've position sized around max loss here, and you're not getting too over your skis on the bullish front, again, you're not risking a lot of money and the risk and reward is very high, right? The reward is significantly high relative to the risk, 2-3 times or more in both of those trades. Let's flip this to the bearish side because look, I mean, with all the inflation information coming out and other things, the Fed, are they going to be on hold? Are they going to cut rates? You'll notice that we kind of came down here on the 10-year treasury yield to about the prior high, and today we're bouncing off of it. The reality is if the Fed is going to cut rates, it might be hard for this to get up to 5% again without a real concern over inflation. I believe we're going to get some PCE data on Friday when the markets close this week. So again, PCE comes after CPI, and CPI was already hot, but that is the Fed's preferred measure. But I do think there's reasonableness that we might see some pressure if the Fed's on hold at 5.25 to 5.5%. 4.5% might be a reasonable high side here, only being 1% below the high level of yield on the Fed funds rate. So we had to overshoot here to 4.5%. But if yields rise, this is generally not going to be great for real estate. Let's take a look at AGNC. This is a mortgage REIT. Okay. We're kind of at resistance here, near-term support here at about 950, downside probably about 928, maybe even stretching to $9. We're kind of just hold up here, but the downside potential risks are huge if the 10-year starts to surge higher. And not to mention, again, some of the default risk in the mortgage space, which this company invests in. Well, today's trade in AGNC was at 5 April, 950 puts. Let me flip this here. So right here, we're buying puts at 950, again, indicating some downside. So very cheap options. You'd probably go out a bit more time here, like 53 days would be reasonable. Buy the 10, sell the 9. Cost in this case, maybe around 40, 39 cents on a $1 wide spread. $9 is right here. $10 is there. Your break even comes pretty quickly on a small downside move in AGNC. Another one too. What about banks? What if all of a sudden the credit losses start to the unrealized losses due to selling off in the Treasury bond market? Bank of America's had a phenomenal run of the last few weeks, trading at highs, but now we're backing off. We saw bullish option activity back here off the lows. Now we're seeing it potentially occurring at the highs. And in this case, this is a 12 April expiration. And I guess it could be reasonable to look at here, but I'm looking at the wrong one here. Sorry. Let's come down here. Clearly wrote down the wrong strikes. We're going to go puts. Let's see, 12 April. So 37 put, part of a spread. It's not showing up here. So this may be a little off. Let's look at the volume here. With 12 April, let's take that at face value, potentially closing that out. So I'm missing what I saw earlier. Sorry. Anyway, I swear there was some. But anyway, we'll throw a few in here and see what we can find. I may have written down the wrong symbol here. Yeah, I'm not seeing it now. Anyway, but let's look at AEO. So watch banking. I mean, this is a space that could roll over to the downside. Also retail, right? Is the consumer strapped? Rising prices? What's the effect on mortgages, the ability to borrow, borrowing costs, etc.? AEO kind of backing off its high today, down 3.74%. Let's look at an April expiration here at the 23 strike right there. So again, some downside activity. $23 is off of the lows down here. We're currently 24.40. 25 days out. Well, shoot. What about a 24.50 23? So buy deep and wide. We'll go one more 4-strike vertical. 24.50, 22.50. Cost is about 69 cents. 22.50. You're selling. There's some premium to be sold down here. Again, the volatility is higher than the one you're buying up here. The one you're selling is about 2% higher in terms of its volatility. 69 cents is not bad. Looking at downside here, retesting the prior low in the next 25 days. What if you extend that out to May? Sorry, that's 3 May. Let's go out here to 17 May. It's not traded, so let's look at the strikes that are traded in May. If you want to give yourself just a little bit more time, again, 24, just slightly out of the money. Buy deep and wide, 112 strike vertical. We're looking at about a 60-cent debit. Buy the 24, sell the 22. So now we've got 53 days for the price to get down to this level down here, and that could occur quickly. Break even occur quickly at about 23.50. Anyway, folks, these are some ideas to take advantage, bullishly and bearishly, but with understanding of the backdrop of the market right now, there's significant downside risks, right? We're very, very peaked right now. And so as a function, you're seeing hedging to the degree we've not seen since mid-December of last year. So again, time to take notice and adjust with the market changes. And we'll see you back next week on the video. Have a great one. Thank you.